Stocks pulled back from record highs yesterday amid a flurry of trade news from the Trump administration. Let's take a look at the technicals. Joining us now, Chris Verrone, head of technical and macro research at Strategas, a Baird company. Chris, welcome. Good morning to you.
Great to be here. Thanks for having me.
It seemed like the pullback was kind of meager given the excuses the markets could have had to pull back even more. So how do you view that in light of where we are in terms of close to record highs?
I think especially modest or benign weakness yesterday. When you look at the leadership, especially discretionary was better than staples. Financials held their own. There wasn't anything terribly distributive about the day. I think it speaks to kind of this broader point that we've been making. When you look at the leadership fabric of this market, it is still very pro-cyclical. Industrials, tech, financials, discretionary getting a little bit better. So if the market's the read on the economy, I think the market's pretty comfortable with where we're headed here.
It did seem like when we turned the page from June to July, there was a real a switch that just flipped on in terms of the more underperforming areas of the market sort of playing catch up a little bit to the leadership that you'd mentioned, industrials, financials, and tech.
Yeah, you saw a little bit of that as the calendar turned from June to July. You had this day, I think last Tuesday, last Wednesday, where the momentum stocks, the leaders, got hit. But it wasn't accompanied with any deterioration to the insides of the market. New highs actually expanded last week. We had nearly 50% of the S&P make a one-month high last week. You have 80% of stocks above their 50-day moving average. So this is still a very well-participated move. It's also very global as well. I mean, you look at these Asian markets that just continue to hum along. The European markets continue to work. So I think we're on pretty good standing here into the second half.
So the markets themselves look good. A lot of people say, well, keep an eye on the 10-year. And the reason why the market's good is because the 10-year yield is pretty tame. I mean, we are in a range. We haven't really cracked above 4.5%. I mean, what does that look like?
I can't, for the life of me, get over all the agita about U.S. 10-year yields when it's not U.S. yields breaking out. It's German yields that are breaking out. It's Japanese yields that are breaking out. All the hysteria about what this tax bill would do to the U.S. bond market is not showing up domestically. I mean, U.S. 10-year yields have been in the same range for the better part of the last 2 years, between 420 and 460. Look at German 30s. They're making new highs this morning.
The way the mainstream media covers spending in Washington does not necessarily dictate to the bond market what's real and what's not.
I think the bond market's been incredibly calm and benign. The MOVE index, which is bond vol, is at new lows right now. If you're looking for stress in bonds, look elsewhere. It's not in the U.S. It's German 30-year yields, it's Japanese 30-year yields, it's UK 30s. It's not U.S. 10-year yields.
If the bond market didn't blow out with the last 4 years, with the new Green Deal and the third round of stimulus and the IRA and everything, why did we, and I use the royal we for mainstream media, why did we cover it like it was going to be the end of the world this time around? And we're, now I'm seeing stories on deficit concerns and reckoning. None of those were done during the Biden administration. Well, now they're all being done. And the big, beautiful bill is going to be the end of the world.
And Joe,
Robert Rubin and,
I think the answer to that's pretty obvious. And I would also add, when you look at gold here, gold's going down, not going up. So if gold was the way all these deficit concerns were expressed in the prior administration, and gold went from 1,600 to 3,000. The fact that gold is not making new highs over the last couple of weeks on the passage of the bill, also on the breakout of war, gold could not make a new high on that. I think pretty compelling that, hey, gold may have topped here for the cycle.
Not even to mention the difference between deficits caused by leaving more money in the private sector from tax cuts versus deficits caused by just more endless government spending and redistribution.
And I think this expectation that the bill or even the tariffs is going to unleash this new wave of inflation, we're just not seeing it in the market. Energy stocks are on the relative lows. Crude's in the mid-60s. Consumer discretionary is getting better, not worse. Tariffs are a tax on consumption. Discretionary should not be breaking out if inflation is on the come here. So I feel relatively comfortable with the macro.